This is a bipartisan thing. The Advance Act that just passed, there was less than 10 no's. Everything else was, and this was bipartisan, Republicans, Democrats supporting these nuclear supportive initiatives. So it sure seems like it. It sure seems like it, Gary. So I think it's kind of game on. We wrote about this kind of in the newsletter. We've crossed the Rubicon.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today, we have a fantastic discussion lined up. We're fortunate to have with us Justin Huhn. Justin is the founder of Uranium Insider newsletter, which can be found at uraniuminsider.com. His focus is the combination of rigorous fundamental analysis and thorough technical analysis. Justin is devoted to bringing value to those that are watching and are involved in the uranium sector, because he believes that the uranium sector offers the most asymmetric risk-reward profile he's ever seen in his entire career. Justin, thank you so much for joining us today.
It's my pleasure. Yeah, thank you for having me on, Gary.
So yesterday it was reported and shown by video that Ukraine launched 4 missiles at Russia's Kursk nuclear power plant. Russian authorities reported no excess radiation detected. According to them, the situation is under control. You know, war is messy, but war is expanding. Should uranium investors be worried here? Can this be the thing to derail the nuclear movement and uranium bull market?
Probably not. And there's always a chance of some kind of exogenous event due to the historical precedents of nuclear meltdowns. There's been a few, right? Obviously, the primary and, of course, the worst ever was Chernobyl. That occurred at a reactor that did not have a radiation containment dome over the reactor core. So currently, there are 0 reactors operating without a containment. The containment domes around present reactor cores are very, very thick. We're talking meters thick of concrete and steel. They're built to withstand 747 plowing into the side of the thing and not actually breaching the containment dome. That's not to say that a missile itself couldn't take it out. I think, in my estimation, the fighting that has been around the Zaporizhia plant in South Ukraine, even going back into the early months of the initiation of this conflict, what it was probably due or probably intended to disrupt electricity production, right? Not to create a meltdown and cause a release of radiation. So all of that is to say, I don't have a crystal ball. If conflict continues to escalate and there's fighting near or around or literally at a nuclear power plant, could it cause disruptions that could create a radiation event? Yes, that is entirely possible. Is it likely? I don't think so. It's likely that it could cause problems at the plant. Would there be an actual partial or full meltdown of a reactor core that would cause radiation to breach an intact containment dome? Probably not. I think that's highly unlikely. When you see the fighting that was happening around Zaporizhia, you actually had kind of some higher up political talking heads in Europe saying Chernobyl Part 2 is about to happen. The reactor is going to explode, and literally that can't happen. With all of that said, we think that the chances of a radiation event are very, very low statistically. But if something were to happen, that obviously would affect sentiment, at least in the near term, just like Fukushima did. So if the Fukushima Daiichi accident in March 2011 caused the uranium equities to pull back for multiple weeks, the sector tried to kind of get on its feet and recover. And then, of course, you had the announcements of all of the reactors in Japan being shut down. So that created a significant negative shift in actual demand for the commodity. So, for example, if this fighting around this plant in Russia disrupts something somehow there, you kind of have to ask yourself, okay, are the Chinese going to halt their 30 reactors that are under construction right now? Probably not. So unless something like this actually causes a change in demand, we think that the disruption would probably be short-lived. But again, there's always that chance. And that is one reason why the sector is so volatile It's one reason why you don't want to put all of your eggs in this basket, but it's also that volatility is something that that risk-tolerant speculators are drawn to as well.
I appreciate the way you just positioned that whole thing. Thank you. So, Justin, in a notice of initial substantial holder that has become public, the bank JP Morgan has acquired 5.09% of uranium producer Paladin. Are big banks now positioning themselves in uranium? And if so, in your analysis, what impact do you expect that to have on share prices?
Sure. Yeah, we've seen reports from BNA, we've seen reports from Citi. There's a handful of others that are covering the sector, that are recommending positions and taking positions in some of the higher cap, more liquid equities. That coverage has just been kind of a slow moving train over multiple years. We think that, and we actually wrote about it in this month's newsletter that we just put out a couple of days ago, which is we think that the sector has sort of crossed the Rubicon here with the latest news of this last 30 days, which is not only these big deals with the tech companies and nuclear operators in the United States, in particular, the news that came out of Constellation being supported by a 20-year power purchase agreement from Microsoft to bring Unit 1 of 3 Mile Island back online, but also 14 of the world's largest banks with 14 trillion in AUM pledging support for the growth of nuclear. So, there's been a number of elements that have transpired over the last 5 years, let's say, that has moved towards more general finance, general bank acceptance of this sector, which is a recognition that it is a clean energy source. So all of these large institutions have ESG desks. They all have an intention to, let's say, support kind of a clean energy transition future, to put it broadly vague. So now that nuclear, and therefore uranium kind of as a second order from a nuclear story, is being accepted with that, COP28 is now, the last COP conference, the last 2 COP conferences, finally nuclear had a seat at the table. It was accepted in the Green EU taxonomy last year, and more it's being recognized on that front. So that is helping all of these things, especially with like very traditional financial institutions actually accepting and supporting nuclear here.
So I do have questions for you on the Microsoft news and on those 14 banks, but I want to ask you about the Palisades nuclear plant in Covert Township, Michigan. They closed a $1.5 billion loan to restart operations. They're going to be the first reactor restart in U.S. history. Does this indicate that we're likely to see that third shuttered nuclear plant restarted, and even new plants built in, the coming months, years? And do you see them even maybe being fast-tracked?
That is possible. It's certainly evident that electricity demand is growing, and it's growing very quickly in the United States, in other jurisdictions as well, but especially the United States, due largely to data center demand and the growth, in particular with AI and large hyperscaler data centers, which are gigawatt and beyond, that are being built currently. There aren't that many options for restarts in the country, due to the time that has passed and the level of decommissioning with most of the reactors that have been shut down in the last 20-25 years in the United States. Like you mentioned, Palisades, that loan was confirmed just this last week. That should be restarted towards the end of next year, within about a 12-month period. That $1.5 billion, there's kind of regular maintenance and upkeep to allow for the restart and the extension of the life of that reactor, but there's also uprates. So you have multiple elements of the reactor's operations being upgraded to allow for even more capacity to be produced there. So that's part of the restart process. 3 Mile Island Unit 1, Constellation estimates that'll be back online by 2028. The governor of Pennsylvania is attempting to influence the NRC to fast track this restart. Excuse me. The last potential restart, as far as we can tell, is the Duane Arnold nuclear plant in Iowa. This is a smaller plant. The operator or the owner of that plant is looking into the potential to restart that plant. Beyond that, not many restarts. I don't think there are any restarts actually potential beyond that. I could be wrong, but that's my understanding. Life extensions, there's more than a dozen reactors that were set to shut down in the United States in the next 10 years. All of them are being are applying for life extensions. So all of the operators of these nukes in the United States, they're operating an environment with higher electricity demand, read higher prices, and they want to extend the lifespan of these units. So that's very evident that that's going to continue to happen in the United States in particular. And as far as new builds goes, everything is moving in that direction. I just attended a webinar this morning from the Department of Energy, and they went over the recently updated Advanced Nuclear Liftoff Report. This was done by the DOE originally last year. They just updated it earlier this week. And excuse me, I'm just getting over a brief illness from traveling to WNA in London. I came back sick. My apologies.
No problem.
This liftoff report is saying that there's 60 to 95 gigawatts of potential new nuclear that can be built at existing nuclear sites. So there's not even a need for new site permits and all of the work that goes along with approving a new site for a new nuclear reactor. At existing nuclear sites in the United States, 60 to 95 gigawatts of potential new nuclear.
That's
multiple large utilities are looking into building new nuclear. Interest is there for SMRs, but there's significantly renewed interest in building large AP1000 reactors. We think we're going to hear announcements of that coming very, very soon. And the DOE is getting loan requests kind of repeatedly and frequently here. They now have $63 billion in loan requests. Part of that is probably in uprates in a number of operating reactors. We believe some of that is with the intention of building new nuclear.
Amazing. Well, so Justin, you mentioned 3 Mile Island and Microsoft earlier. Microsoft made that big announcement a few weeks back to restart 3 Mile Island. Other big tech companies, they're following suit. So given the recent surge in interest from big tech companies like Google, Amazon, Microsoft, Facebook, et cetera, in nuclear energy, what does this indicate about future energy needs? Like, how big is it really, and the potential role of nuclear power in meeting those demands, considering, the length of time it takes to actually get one permitted and built?
I think that the tech companies are recognizing the need for nuclear, despite the fact that it's going to take some time to build new nuclear. So it's probably going to be an all of the above strategy to meet these electricity demands. As far as we can tell, a limiting factor for the rate of expansion of AI, to put it simply, is going to be electricity availability. That's how it's looking, how quickly this is growing. Just this past week, the CEO of NVIDIA was asked if we can win the AI race without building new nuclear. He responded, "It's impossible." Yeah. And like you mentioned, Meta, Amazon, Google, Oracle, all representatives from all of these companies have been discussing nuclear and looking into nuclear meeting their electricity needs. So most likely nuclear and geothermal are going to be big beneficiaries. Will there be expanded natural gas production and potentially solar and battery backups and things like that to bridge that gap between now and when we can drastically expand nuclear? Probably. I think it's going to have to happen. However, the tech companies they're very sensitive about the type of messaging that would come from an expansion of fossil fuel powered electricity in order to expand their data center growth. So, and then there's other issues with, solar, for example, has the best capacity factor, which is in the low 20th percentile in the desert Southwest, where it reaches, north of 100 degrees for months at a time. These data centers run very, very hot. Part of the reason the electricity demand is so great is literally cooling these units. So there's some issues with that. So the tech companies seem to understand that solar is not only with the heat issues, but the intermittency. Nuclear is firm, it's baseload, and it's clean. It ticks all of the boxes, very low land use. So it's looking like this is going beyond this theoretical that nuclear should be the solution. They're actually looking into it. They're securing what they can of restartable nuclear and currently operating nuclear, but clearly it's looking like new builds are going to happen to meet the projected demand coming from these data centers.
And since the tech companies are so sensitive to the messaging that they're their energy utilization presents. And because they're so hyper connected to the government, you would think that the government would fast track permitting in order to help them have the appropriate messaging that they all want to present.
Sure, yeah, and that is part of what I would say is a correct assumption. You would think that that's the case. The NRC is very slow typically to approve new site approvals and new design approvals. So there's a small handful of new advanced reactor designs that are moving through the NRC currently. But to your point, there are multiple dozens of existing nuclear power plant sites that are already permitted for additional units that would require nothing essentially I mean, not nothing, but they already are licensed for more units to be built at that site. And Westinghouse's AP1000 is also already licensed. So if they want to build new AP1000s at existing sites with permits for additional units, they can do it tomorrow if they can get the financing and get the get the skilled labor. 30,000 people were trained during the process of building Vogtle 3 and 4 in Georgia, the AP1000s there. So entirely possible to get moving on this relatively quickly. And like they repeated ad nauseum this morning in this webinar, the DOE reps, there's a 30 to 50% clean energy investment tax credit from the Inflation Reduction Act. This is literally cost sharing coming from the federal government. So the overall cost of building one of these new plants for an existing utility that is already paying enormous amounts of corporate tax from their existing operations, these tax credits essentially share the cost of building new nuclear. So
Wow.
It's all conspiring to move in that direction. Like I said, we're expecting announcements of new builds coming pretty soon here.
Yeah. So you mentioned a few weeks back the huge banks, 14 of them, they came out in support of nuclear energy, with major Wall Street banks like Goldman Sachs, Morgan Stanley, and Citibank backing efforts to triple global nuclear energy output by 2050. Is this really the key signal, the bat signal, if you will, that the new era for nuclear power and the uranium market is now underway?
I think so. The financing risk, it's really kind of one of the last pieces of the puzzle of whether or not the West is going to accelerate, nuclear builds, or whether or not the U.S. specifically will ever build new nuclear again. Will the banks touch these projects? So the banks are saying, yes, we will. And everything else, I mean, the DOE under the Biden admin has been phenomenal, incredibly supportive. And these, of course, are largely lifers that have been at the DOE through multiple administrations, Republican and Democrat. But this is a bipartisan thing. The Advance Act that just passed, there was less than 10 no's. Everything else was, and this was bipartisan, Republicans, Democrats supporting these nuclear supportive initiatives. So it sure seems like it. It sure seems like it, Gary. So I think it's kind of game on. We wrote about this kind of in the newsletter. We've crossed the Rubicon. I think that this situation has changed, and I think that there's a lot of new generalist interest in the sector.
So speaking of this game on concept, Justin, given the strong support of the G7 governments, big tech companies, banks, and the media even for expanding nuclear energy, are you seeing this as now the sector's poised for significant growth and investment from institutional investors, which is going to benefit the key producers, but also the juniors? And in essence, it's going to create a rising tide raises all boats scenario, because there's only so many uranium, companies out there.
It's a small space to begin with, but when you're actually talking about, mid-large cap vehicles that are liquid enough for institutional money to touch, you can count those in one hand. So luckily, a couple of those options on that one hand are ETFs, and those flows tend to also support the mid caps and to some extent the larger of the small caps. Thus far, with the exception of perhaps the first really big leg of this market, which was late 2020 to late 2021, where everything moved and the small caps outperformed the large caps by a significant margin. Since then, generally speaking, it's been an outperformance of the large caps. And that, of course, usually in resource bull markets, usually kind of shifts. And when there's much more attention coming to the sectors, you often have the small and the mid caps then kind of take over and lead the race. We haven't seen that yet. So at this point, it's still theoretical that money rotation will happen, or perhaps it's just an ETF flow situation with lower float small caps, right? But we think it's going to happen. We're positioned largely in mid-cap developing companies. Thus far, the smart money, quote unquote smart money, can only really go after Cameco and NextGen, Denison, Paladin, the ETFs, and SPUT. That's pretty much it. So, and that's what they've gone after. And of course, the utility stocks have been on an absolute tear, and they have liquidity. The Vistra Constellation, their liquidity is twice that of Cameco. So this is something that the large caps can play the theme with. That's highly liquid.
So there's a historical pattern of parabolic spikes followed by sharp declines in previous uranium bull markets. That's been repeated a couple of times. In your analysis, what are you anticipating for the current bull market? And do you see this as something being similar where it's a spike comes down, so it's a short-lived type thing? Or do you see this as a play that should be a cornerstone in somebody's portfolio because it's going to last for a while?
I would say it's more of the second option. There's always the possibility of a price spike that can come from a disruptive event. And that type of disrupted, and I can tell you that the market dynamics currently are ripe for disruption without knowing really what might be the disruption. So the disruption could be, for example, the previous bull market, we had one of the disruptions was a flood at Cigar Lake as it was being developed. And this was a new mine under construction that the utilities and the physical uranium market, generally speaking, was expecting to move towards production on an expected timeline, and then something disrupted that, and it certainly assisted in the rising price. But that also was a very particularly unique point in time, in that it was, in hindsight, the last year or two of a everything run before the GFC, and the big spike from, let's say, 60, 70, 80-ish dollar range in spot up to 134 was largely driven by financial interests, hedge funds specifically buying uranium. So the fact that spike was driven by the financial interests, when the GFC started to hit, that's part of what led to the steep decline on the other side of that. Of course, that decline came back down. I think it came back down into the 40s, and then it started to recover up into the 70s before the Fukushima Daiichi accident. This time around, the demand that is currently happening in the market and projected to take place in the physical market in the next 5 years is largely utility demand. So in going out to 2040, there's 2 billion pounds that have yet to be contracted of uncovered demand based on existing reactors that we know will be operating to that date and reactors under construction that will hit the grid during that period of time. That's a lot of uranium that needs to be purchased. Utilities generally are covered in the near term, always, because it takes so long to move material through the fuel cycle. But the fact that the previous market was driven by these disruptive supply events and then financial cornering of a market in the last gasp of a major equities across the board, broad market commodities that were all soaring 06, 07 before the crash, right? So all of that led to that spike. The difference here is that the main financial influence that has happened in this market has already happened. I don't think there's going to be enormous influence on this market, probably ever again, by the Sprott Physical Uranium Trust. While they have bought a little more than 2 million pounds this year, and they've raised cash on a couple of fits and starts, they've been trading at NAV roughly for the last week and a half, which is great. Bought another 200,000 pounds in the last 5 or 6 days. It's not nothing, but we're not going to see 40 million pounds purchased in 12 months like we saw in 2021, 2022. Not going to happen again. Not only because I think that it's going to be more difficult to see that level of money come in at a significant premium. I think that was a one-time thing because of the newness of the vehicle. These closed-end trusts are sort of predetermined to eventually trade almost persistently at a discount. with small exceptions, but also the price is so much higher now than it was in 2021. So on balance, you raise the same amount of money, you can buy 30% of the uranium you could have bought, right? So I think SPUT has done the heavy lifting already. Hedge funds are still involved. Goldman Sachs has been buying uranium. They sell a little bit of uranium here and there also, but on balance, they've been buyers. Last year in the run-up that we saw, August through January, they were in there, but they weren't alone. Producers were buying, utilities were buying, traders were buying, and the financials were buying. So there's way more participants here. It's not something that's being driven by the financials. They're just one small part of it. So the utility demand is really what's going to be the long-term driver of higher prices. And this is a very, very unique sector in that supply is not, or the price of the commodity is not dictated by one or two big suppliers voluntarily cutting or voluntarily producing more. Everybody is trying to produce more right now, and they're having trouble doing it. And so you can pretty easily model out supply and demand. Demand is pretty static. The reactors are long-lived assets. You make some sort of enrichment tails assumption, you can plug in a number, and you can see what the demand looks like going out into the future with a couple of assumptions you have to make. Same thing with supply. And supply is constrained. So we see a 3 to 5 year period from right now where supply is not going to be able to reach demand. If 4 or 5 large projects come online on time successfully, we might see a balanced market for a point in time before we get into the 2030s, where demand is substantially higher than it is right now, and a number of producing mines that are currently producing start to see decline rates. Half of Kazatomprom's assets have steep decline rates in the 2030s. Cigar Lake Phase 1 is over in the next 3 years. Phase 2 will be going, it'll be declining. Langer Heinrich, Husab, Rossing, all of these producing mines currently all have decline rates in the 2030s. So we really need a lot of supply to balance anything remotely close to the demand projections that are being proffered and proposed by COP28, DOE, etc. And even with, a lower reference case of expected demand, we still need a lot of supply to come online.
So in the previous bull market run, everybody participated from the majors to the juniors. Do you see everybody participating in this one? And what do you think will be the catalyst to get investors to start moving from those mid-cap and major producers and into the juniors?
Well, I think in many ways, size kind of begets size. So if you manage a small fund and you're trying to make a $10 or $20 million allocation into the sector, you can't touch the small caps. You can't invest in them directly. It's just there's not enough liquidity. Period. The end. So for the large players, they're going to only be able to buy what's liquid enough. And for the really large funds, let's say north of $1 billion AUM, when they get an interest in the sector, they end up calling some of the specialty funds, hiring some analysts to give them a pitch on the sector. If they feel like they get the thesis, even without doing any of the work on their own, but they get it and they want to create a small allocation, which a small allocation to a large fund might be 30 to 50 million and potentially more. They bring up their Bloomberg, they sort by liquidity, and they buy whatever's in the top 5. And that's it. They don't do any more work, period. Like I said, luckily, oftentimes that's ETFs, and the ETF flows will drive just about everything. But hopefully, we will get to a point where the sector grows significantly beyond its present size, which is what, 70 billion, just off the top of my head. The sector grows enough, that size, and for the retail mind, it's very difficult to comprehend the strategy of an institution. And it's always just buy low, sell high, right? So in retail mind, you can't understand why utilities didn't stock the hell up when uranium was 25, 35 bucks. They don't operate like that. They buy what they need to buy when they need to buy it. They're not in the business of timing the market, and they're not really allowed to time the market based on the dictates of management in most of these utilities. Same thing goes with institutional investors. Liquidity is paramount, more so than valuation, more so than looking at the chart and saying, oh, I just missed a 100% move. It doesn't matter. It's liquidity, liquidity, liquidity. So this year is a prime example of that. A couple of large funds with these factor baskets that were trying to get second order, third order plays on AI went after uranium back in April and May. They chased it up. They bought near the top. Liquidity was there. They got the theme. AI bubble sort of popped over the summer. They bailed. They sold all the uranium. They dumped shares 4, 5, 6 weeks in a row. And that absolutely affected this small sector. So these big players, they don't really know the story. They'll come in, they'll chase it up, they'll dump it down. This is going to continue to happen. But on balance, theoretically, the sector should grow, especially with this more recent news. And when that size grows, more liquidity, more money can come into the sector. Eventually, most of these small and mid caps, especially if it's a company that has company-specific drivers, whether that's an exploration hit, some M&A activity, whatever it might be. With all of that said, final point, this is not the top of the first inning, right? This sector has, the commodity is up 4x since the bottom. We've had some big moves off the bottom. This has been a big consolidation over the past 2-3 years, but it's still, we're far enough along in this story that the wheat and the chaff have kind of been separated. So you don't want to go in as a retail investor with the ability to buy some of the small stuff and be like, oh, this one hasn't moved yet. That must be a incredible value proposition. Maybe, but maybe not. You got to do the work. You got to dig into what has caused that underperformance, because at this stage, it's something that has caused that underperformance.
So, Justin, supply risks are rising, and they seem to be rising almost daily. Production shortfalls from major producers like Kazatomprom, that's happening as well. With the growing global demand for uranium that you've already articulated, can you see a time when there's a possible significant price surge, maybe even happening in the next 12 to 24 months due to these supply constraints and production issues? I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They are all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with Justin as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video.